All right, guys, welcome to day 3 of this course. We are now going to go over a very critical concept, which is going to be reversals versus pullbacks. How do you understand or know that price is just going to pull back versus this is a proper reversal? Now, we're going to tie in all the concepts that we have went through here together for the past few days, and we're going to take a look at this chart. So let's get right into it. So first thing we want to identify, again, as always, is buy side and sell side, right? So we have a clear buy side liquidity level right here that gets swept, and we are currently trading above it. And then we have a clear sell side liquidity level that we have down here, okay? So these are going to be the two levels that I will keep on watch. These are the two levels that we want to see how price reacts to them, okay? So we have the buy side level here. I'm going to drop down into a lower time frame, and I'm going to watch and see what happens. Now, you guys can see we push lower into this fair value gap, okay? Now, if you guys remember from a few videos ago, I told you that the fair value gap or PD arrays that form after market sweeps a high or a low is called a structural PD array. So this is a structural fair value gap in this leg of multiple different PD arrays. This is going to be the most important one, okay? So this is the fair value gap that we're watching. If we want price to continue making new highs, we want to see this fair value gap deliver and make new highs, right? If this fair value gap gets inversed and we close through it, then that means we probably have a reversal on our hands, right? So let's see how price reacts to this exact fair value gap. Now, right now we have a wick out of it. The body is respecting the midpoint of this fair value gap so far. Let's see what continues to happen. As you can see, we could try to continue making new highs, and then what happens right here? We close through the midpoint of this fair value gap, okay? Now, closing through a midpoint of a fair value gap is a pretty big deal. There's quadrants inside of a fair value gap, right? So think of it as an upper half and a lower half. So if a fair value gap is truly bullish, then we want to see this upper half get respected, okay? Ideally, we don't want the bodies to be closing below this upper half. But if we close below this upper half, right, then that means that there is a very good chance that we inverse through this fair value gap. So what do we do on the following candle? We inverse through the fair value gap completely. Not only that, but we also inverse through and make this order block, right? So now we have an order block and a breaker block right here, right? So this can be a short entry if you would like it to be, right? And we are now obviously going to go ahead and target these lows that we have. So we have some internal lows. We got this low, and we have the low underneath us that we had the sell side liquidity level from. You have this bearish gap right here. We can see if price pulls into that to respect it, and it pulls into it, right? So as soon as it pulls into that fair value gap, this becomes an entry short because we have true reversal structure. Stop loss goes above the gap, and we simply just go ahead and target that previous buy side liquidity level that we had, or sorry, sell side liquidity level that we had earlier. And you guys can see how do we react straight into that sell side liquidity level, okay? So that is one example of a reversal. Now, when price comes down into this sell side liquidity level, there is going to be a few things that you want to look out for. You want to look out for certain PD arrays that are down here, right? So as you can see, we have this hourly fair value gap below, right, which happens to be in a discount. So if we go back and we go and get the range high to range low. So this is the range low here, and that's the range high, right? And if I extend that out, you guys will see this fair value gap lies in the discount of this range. So while on the lower time frame chart, when we swept this buy side liquidity level, right, the exact trade that I just went through and showed you guys, while we had a reversal on the lower time frame chart, on the higher time frame chart, it is simply just a pullback to come down into this fair value gap and then get another reversal, right? So let's see what happens. So we have a new buy side level. It's up here. Okay, so what we'll do is we'll go and drop down into the 5-minute time frame, and we will watch and see what happens. So price comes down into this this 1 hour fair value gap within discount, and then what do? Again, same thing, right? Same rules apply. We have a fair value gap right here. This is going to be your structural fair value gap. Again, why is this your structural fair value gap? Because this was the one that was created after we swept this low, right? After we swept the low, this fair value gap here was created. So this is going to be the one that we would want price to reject to go and make new lows, right? But what happens when price comes up through this area? It simply inverses right through with one absolutely massive Drake candle. Don't ask me why it's called a Drake candle. And it goes straight into that buy side liquidity level. Okay, so once this happens, we clearly can see on the higher time frame that this was simply just a pullback. And because the higher time frame is very, very bullish, we will assume that any move lower up here will also be a very simple pullback, right? So if I go on to the 1 minute and I continue on here, you guys see this move into this fair value gap. Again, fair value gap right after a high has been broken, right? So this was a buy side liquidity level. We break through the high and we create this structural fair value gap, right? We would want to see this hold. We want to make it a new high here, right? The difference between the move back here and the move here is that we reached into this hourly fair value gap, right? The 1 hour FVG. And this is important because this is where the 4 hour candle is delivering out of, right? So this is the 4 hour PO3 taking place, right? You guys can see the 4 hour candle on this right hand side right here. So this is just a simple 4 hour PO3 taking place to go higher. Now, that is the key difference between the move here and the move here. So this fair value gap we expect to hold, right? And you can go and enter long, stop loss, again, stop loss below, and we want to see at least 2R. So let's go 2R here would be, yeah, let's just say right there, okay? And let's see what happens to price. Goes and completes and fills our, well, this was a 2.11R, right? That's the entire trade complete, okay? So this is the key difference between that pullback and this move up. Now, again, after we have respected this fair value gap here, you guys know the market obviously does not just move, like it doesn't just go and pull into a fair value gap and then just move higher, right? Like that's not how it works. I wish that that's the way it worked, but it doesn't. It'll go a bit like this, right? Where you have some pullbacks, right? Like this is how the market moves when it's in an uptrend. When it's in a downtrend, it moves the opposite way, but you know, there's still, you can clearly see a downtrend, right? This is a clear sell model, but inside of that sell model, you have higher highs or higher lows that might get created. So you guys can see here, all of these little moves back into these PD arrays that we have. For example, we have these down close candles. In an uptrend, all these down close candles are going to act as an area of support, okay? And in a downtrend, all these up close candles are going to act as an area of resistance. So we see these up close candles, or sorry, these down close candles right here. So here's one that I can mark out clearly, and you guys can see we get these little pullbacks into these areas, right? We get the little pullback and then we get the move out. This is the clear difference between a pullback and a reversal, right? For the reversal, a higher time frame level or higher time frame PD array has been reached, and only then can a reversal happen, right? So this is a rule that you have to remember. So for a reversal, there has to be a higher time frame level. I'll just say level because this will include PD arrays and all that. So there has to be a higher time frame level that has to get reached, right? And for a pullback, the higher time frame level has not been reached, right? So pullback is very simple because, oops, why did that go away? Sorry, I'm not the best at art. For the pullback, we still have a draw on liquidity is intact, okay? So we still have a clear upside draw on liquidity here, and that is the reason why these are pullbacks and this was a reversal on the lower time frame, right? that is a pretty good example to show you why in the last video I mentioned that the lower time frame you want to kind of try to stick away from. You want to stick with the higher time frames because price is much more accurate on a higher time frame, right? A reversal on a 5-minute or a 15-minute holds much more weight than a reversal on a 1-minute or a 2-minute or a 3-minute, whatever, right? So that's why you want to focus more on those higher time frames. Now, if I'll do one more example here really quickly. We'll try to go on a higher time frame, like a 15-minute potentially, if I can find something. And what you want to do is you want to look for trends like this, right? When you have a clear trend, right? Once market structure has shifted and you have a clear trend to one direction, then the moves that you're going to get lower are going to be your pullbacks because a draw on liquidity to the upside is still intact, right? So for example, if we take this range here, you guys can see this high, right, is going to be our draw on liquidity. Why? Because there's a untouched new weekly opening gap up here, right? So as long as there's that untouched new weekly opening gap, we know that we have a clear upside draw on liquidity that is intact, okay? So what happens here? I'm just using this leg as an example, just quickly zooming in. I'm using this as an example. So when we go over here, what we want to do is, again, premium to discount. So let's mark that out and let's see where's discount. What do we have inside of discount? So most of the reliable pullbacks that you'll have that you really want to use are going to be inside of discount, okay? So what do we have underneath this 50% level? I can only see one thing, and that is this fair value gap here, okay? So this fair value gap, if price pulls into that fair value gap, we use that to long, and this is essentially going to be our pullback area where we can pick those longs up. I do see another one up here, actually. This is the one that got used, so you can see right under the 50% level, price pulls into it, and then we get a reversal out of there, right? So clear difference, understand that difference between the pullback and the reversal, right? And then obviously price goes into the upside draw on liquidity. And then what happens when that draw on liquidity gets hit? Clear reversal, right? Clear reversal. And it's not just on a lower time frame, we're on a 15-minute, so you can see 15-minute time frame starts to get a reversal. You guys, let's mark out all the PDRAs here. So we have fair value gap here, fair value gap here. We have this order block, right, which is effectively a breaker once we close under it. So we have the breaker right there, okay, and this is about all we have over here. So we have 3 different PDRAs that get violated, and then it makes this move lower, okay? 3 different PDRAs is the most ideal situation that you want to look for, okay? So, you know, obviously you can enter if you have an inversion or a breaker or whatnot, but if you're really, really married to a bias, the way that you get away from that bias is you want to focus on 3 different PDRAs. So once 3 PDRAs have been hit against you, then that means that your trade is not going to work out, okay? 3 PDRAs, remember that rule. And that's going to be it for this video, guys. I'll see you in the next video.